Welcome to my channel. I am going to walk you through the process of valuing 2 US REITs and 3 Canadian REITs and analyze their financial ratios. Become a member of the channel and I could do a more in-depth valuation, or we can do a private Zoom session where I can show you how to analyze financial statements and answer any questions. See the link in the very top of the description. The first company we're going to look at is Empire Realty Trust. It owns, manages, and operates office and retail properties in Manhattan and the greater New York area. Let's get started with the model. This is a small cap company. They have a market cap of $1.7 billion. They're trading at $5.79 a share. And to get the shares outstanding, its market cap divided by stock price gives you shares outstanding 294 million. And we're going to need this number later when we calculate the value of the company. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that back to today's dollars. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. If a company has positive free cash flow, that means they're generating more cash than they're spending. If a company has negative free cash flow, it could mean they're investing in their business to grow it later on. You want to look at the detail to make sure they're using the money to grow their business and not losing money on their operational business. This company has positive and consistent free cash flow each year, so that looks really good. Their net income also looks pretty consistent. Their revenue doesn't seem to move too much. It's going up a little bit. It's pretty consistent though. Everything looks good. Let's look at a capital structure. They have $1.7 billion of debt. They pay 4.75% interest on their debt, and they don't pay taxes. Most REITs don't pay taxes because they distribute at least 90% of their profits out as dividends, and the investors who receive the dividends pay taxes. So the cost of debt is 4.75%. They have 57% debt in their capital structure, which means they have 43% equity. The cost of equity is 7.39%, and we use the capital asset pricing model to figure that out. The beta is part of the capital asset pricing model, and the beta is how volatile the stock is relative to the market. The market as a whole has a beta of 1. This has a beta of 0.66, so it moves less than the market, so it's less volatile. The lower the beta, the lower the cost of equity. Their WACC is 5.88%, which is a blend of the cost of debt and cost of equity, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 1.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.1 billion. We divide that by 294 million shares, and we get a calculated stock price of $7.18. They're trading at $5.79, so they're trading at a 19% discount. It's a buy according to the model. Let's see what Simply Wall Street says. They're saying $5.90, so they're also saying the stock is undervalued, but not nearly as much as I am. Let's see where the stock has been trading at the past few years. The stock was trading well over $20 at one point, but it keeps dropping. If I valued this company a few months ago, it would have been an overvalued stock, but right now, according to my model, it's a discount because the price has come down so much. Let's look at the financial ratios. Not such a good PE. The median in the market is 16.5, the average is 18.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 34.4. So investors are paying $34.40 for $1 of earnings. Price of sales is good. The median is 1.9, the average is 5.1. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 2.3. So investors are paying $2.30 for $1 of revenue. Their price to book is also really good. The median in the market is 2.3, the average is 4.8. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 1.4, so investors are paying $1.40 for $1 of book value. They have a good interest coverage ratio. The average in the market is 12.9, the median is 4.0. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0, they're at 2.0. EBIT is earnings before interest and taxes. also called operating income on the income statement. They have a weak ROE. The median is 12%, the average is 13%. ROE is net income over equity. I like to see above 20%. They're at 4%. Equity is total assets minus total liabilities on the balance sheet. Current ratio is really high. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 4.5, so they can definitely cover their current assets, but you generally don't need so much current assets on your balance sheet. If it's above 2.0, it indicates they may be operating inefficiently. The best way to look at ratios is to compare them to similar companies. I've done videos on H&R Real Estate and WP Carey, both in the same industry as Empire. And if Empire has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So when you look at REITs, you should always look at funds from operations per share. Funds from operations is net income plus depreciation and amortization minus the sale on gains of real estate. And this line is price of stock over funds from operations per share. And I like to see below 15. The average in the industry is 8.6. Empire is doing really well at 5.7. H&R is even better at 5.6. Both of them have really good price over funds from operations per share. In terms of PE, Empire is a little worse, but they have the best price to sales ratio of the three companies. They're a little worse in price to book. They have the highest current ratio. ROE, they're about average, but they're all pretty low, the companies. Debt, they're a little higher than average in debt, and they're the smallest in market cap of the three companies. But they do pay the highest dividend. Their dividend yield is 6.95%. The average is 6.66%. So to summarize, I have them trading at a 19% discount because their stock price has come down so much. Their ratios look a bit weak, but their financials look strong. The second company, which is also another US REIT, is Invitation Homes. It owns and operates single-family rental homes. Let's get started with the model. This is a big company, 14.8 billion market cap, so they're a large cap company. They're trading at 26.44 and they have 560 million shares outstanding. Their free cash flow looks really good. It's growing each year and it's a pretty healthy number. Although their net income doesn't look good, they're not doing a good job managing expenses. They're losing money. Net income is revenue minus expenses on the income statement. Their revenue is growing really fast. It went from 900 million to 1.8 billion. So they're doing a good job growing their sales. They just need to do a better job turning those sales into net income. They have $8.4 billion of debt. They pay 4.3% interest on their debt. And their cost of equity is 8.8%. And we used a beta to figure that out. The beta is how volatile the stock is, and they have a low beta of 0.84, so the stock moves less than the market. You generally want to invest in a stock that's not too volatile because it's more predictable. Their WACC is 6.5%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 5.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.2 billion. We divide that by 560 million shares, and we get a calculated stock price at $9.34. They're trading at 26, so they're trading at a 183% premium. It's a sell according to the model. Let's see what Simply Wall Street says. They're also saying the stock is overvalued, but their number is much higher than me at $24 a share. The way they come up with their valuation is they take the average analyst estimate. Let's see where the stock has been trading the past few years. So it looks like the stock price broke $30 right before coronavirus hit, but it dropped in half. It's come almost way back up there. So according to my model, it seems overvalued. Let's look at the financial ratios. Really bad PE, that's stock price over earnings per share. I like to see below 15, they're at 102. Also bad price to sales, that's stock price over sales per share. I like to see below 2.5, they're at 8.4. Really good price to book, that's stock price over book value per share. I like to see below 3.5, they're at 1.8. A weak interest coverage ratio, that's EBIT over interest expense, so they could just cover their interest payments. They don't have much left over for other expenses. ROE is net income over equity. I like to see above 20%. They're only at 2%. And they have a really bad current ratio. That's current assets over current liabilities. I like to see between 1.2 and 2. They can only cover about 20% of their current liabilities, so they need to take on a lot more debt. The best way to look at ratios to compare them to similar companies, I've done videos on Avalon Bay, Canadian apartment properties, Equity Residential, and UDR, all in the same industry as Invitation Homes. And if Invitation has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So the important ratio in REITs is the price over funds from operations per share. They are better than average at 25, but I like to see below 15 for this ratio, so I think 25 is still kind of high. But everybody in this industry is pretty high, above 15. They have a bad PE, it's much worse than the average. Their price to sales, however, is better than average, even though it's kind of high. Price to book is a little better than average. The whole industry is terrible in current ratio. A lot of these companies could go bankrupt. ROE is really bad. Debt is a little worse than average. Their market cap is a little higher than average. And this company pays the lowest dividend. They have a 2.18% dividend yield. The average is 3.6%. To summarize, I have them trading at a 183% premium. Their ratios are okay, but their financials are kind of weak with negative net income almost every year. The third REIT and the first Canadian REIT is H&R Real Estate. It is the third largest REIT in Canada after RioCan and Choice Properties. H&R's portfolio includes 40 office properties, 161 retail properties, and 105 industrial properties, with a total value of $13 billion. Let's get started with the model. This company has a market cap of 2.7 billion Canadian dollars. They're trading at $9.51, and they have 284 million shares outstanding. Their financials look really good. All their numbers are positive and consistent. Their revenue doesn't seem to be growing, but it's not falling too much either. They have $6.4 billion of debt. The cost of debt is only 0.5%. The cost of equity is 14.9%. And their beta is 1.64. That's how volatile the stock is. So it's a bit volatile. It moves more than 1.5 times the market. And their WACC is 8%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $4.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.9 billion. We divide that by 284 million shares. We get a calculated stock price of $17.22. They're trading at $9.51, so they're trading at a 45% discount. It's a buy according to the model. Simply Wall Street values them at $40, much higher than me. So they're saying the stock is extremely undervalued. Let's see where the stock has been trading at the past few years. The stock has been trading in the mid to low 20s for a long time. Then in March, April, when the market crashed, this stock crashed big time, and it's been sitting down there ever since, so it hasn't really come up. So it looks like it could be a great value. Let's look at the financial ratios. They have a good PE, that's stock price over earnings per share. I like to see below 15, they're at 7.9. Good price to sales, that's stock price over sales per share. I like to see below 2.5, they're at 2.3. And a really good price to book, that's stock price over book value per share. I like to see below 3.5, they're at 0.4. So the reason these ratios look so good is because their stock prices come down so much. Stock price is the numerator of each equation. Really good interest coverage ratio, that's EBIT over interest expense. They're at 21. I like to see above 2 so they can easily cover their interest payments. They do have a low ROE, that's net income over equity. That's only 5%. I like to see above 20%, so they don't provide a good value to their equity holders. Current ratio is a little high. That's current assets over current liabilities. I like to see between 1.2 and 2. There are 2.8. The best way to look at ratios to compare them to similar companies, I've done videos on Empire State and WP Carey, both in the same industry as H&R. And if H&R has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in just about every category. They have the best price over funds from operations per share. They're much better in PE. They're much better in price to sales. They have a best price to book. They have a good current ratio. The ROE is bad, but it's the highest of the three companies. They're a little lower than average in debt. Their market cap is in the middle of the three companies. They pay a good dividend, almost 7%. So to summarize, I have them trading at a 45% discount. Their ratios look amazing and their financials look really good. The fourth REIT and a second Canadian REIT is Dream Office. This company owns high-quality office properties in major urban centers across Canada with a focus on Toronto. Let's get started with the model. This has a market cap of 1 billion Canadian dollars. They're trading at $18.17 a share. Free cash flow looks pretty good. It's a little low, but it's positive and consistent. The net income also looks good, except for 2016. They took a big hit of negative $880 million. Revenue is really bad though. It's dropping every year, so that's not a good sign. They have $1.1 billion of debt. They pay 4.7% interest on their debt, and they have 44% debt in their capital structure, which means they have 56% equity. Cost of equity is 8.62%, and the beta is 0.82. That's how volatile the stock is. So it's a low beta. It's not too volatile. The WACC is 4.85%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year at 4. That's $536 million. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of 537 million Canadian dollars. We divide that by 55 million shares. We get a calculated stock price at $9.76. They're trading at $18, so they're trading at an 86% premium. It's a sell according to the model. I'm at $9.76, Simply Wall Street at $38, a big difference. Not sure why, because their financials look pretty weak. Their revenue is going down a lot. And I estimated the free cash flow using a pretty normal model. I didn't do anything aggressive. It's in line with where they're at. Let's see where the stock has been trading at the past few years. The stock price was driven up to the mid-30s. Then when the market crashed a few months back, the stock price crashed big time, and it's only been going down little by little. Doesn't seem to be coming up at all. Let's look at the financial ratios. They have a good PE, that's stock price over earnings per share. I like to see below 15, they're at 8.5. Weak price to sales, that's stock price over sales per share. I like to see below 2.5, they're at 4.4. They have a good price to book, that's stock price over book value per share. I like to see below 3.5, they're at 0.7. Good interest coverage ratio, that's EBIT over interest expense. I like to see above 2, they're at 2.1. They have a low ROE, that's net income over equity. I like to see above 20%, they're at 8%. They have a bad current ratio, that's current assets over current liabilities. I like to see between 1.2 and 2. They're only at 0.4, which means they may need to take on more debt. The best way to look at ratios is to compare them to similar companies. I've done videos on City Office REIT, Digital Realty, SL Green, True North, and Vornado, all in the same industry as Dream Office. If Dream Office has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're better than average in price over funds from operations per share. They're better in PE, also better in price to sales. They have the best price to book of all the companies. They're really bad in current ratio. They're worse than average in ROE. They have the lowest debt of all the companies, and they're on the smaller side of all the companies at only 750 million Canadian dollars. Their dividend yield is a little lower than average at 5.25%. The average is 5.36%. So to summarize, I have them trading at an 86% premium. Their ratios look okay, but their financials look pretty bad because their revenue keeps going down. The fifth REIT and the third Canadian REIT is Northwest Healthcare. This has a portfolio of high-quality healthcare and real estate. It has 175 income-producing properties throughout Canada, Brazil, Germany, Australia, and New Zealand. Let's get started with the model. They have a market cap of $1.9 billion. They're trading at $11.04 a share, and they have 172 million shares outstanding. Their free cash flow looks pretty good. It's consistent, and it looks like it's at its highest number in 2019. The net income looks good in 2016, 17, and 18. It is negative in 2019, but that could be a one-time charge. And their revenue seems to be growing a little bit each year, so everything looks pretty good in their financials. Their debt is $2.7 billion. The interest rate is 4.6%. Cost of debt is 3.8%. To get cost of debt, it's interest rate times 1 minus the effective tax rate. And they have 67% debt in their capital structure, which means they have 33% equity. Cost of equity is 8.7%. And their beta is 0.83, so the stock is a little less volatile than the market. Their WACC is 5.4%, which is a blend of the cost of debt and cost of equity, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $2.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.5 billion. We divide that by 172 million shares. We get a calculated stock price of $14.45. They're trading at $11, so they're trading at a 24% discount. It's a buy according to the model. Simply Wall Street has them at $19 a share, so they're saying it's even more undervalued than I am. Let's see where the stock has been trading in the past few years. The stock peaked about $13. It dropped a lot and it's come back up. It's not quite to where it was before coronavirus, but it's getting close. So it looks like it still has a lot of room to grow. Let's look at the financial ratios. They have a negative PE, that's stock price over earnings per share. They have negative net income, so they have negative PE. Not such a good price to sales ratio, that's stock price over sales per share. I like to see below 2.5, they're at 5.2. Good price to book, that's stock price over book value per share. I like to see below 3.5, they're at 1.4. Good interest coverage ratio, that's EBIT over interest expense. I like to see above 2.0, they're at 2.0. Negative net income, so we can't look at the ROE. Current ratio is good, that's current assets over current liabilities. I like to see between 1.2 and 2, they're at 1.3. The best way to look at ratios is to compare them to similar companies. I've done videos on LTC Properties, Medical Properties Trust, National Health Investors, Omega Healthcare, and Well Tower, all in the same industry as Northwest. And if Northwest has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are worse in PE. They're better in price to sales and price to book. The current ratio is great. ROE is worse than average. They have higher debt at 67%, average is 53%. They're much lower market cap at 1.4 billion US dollars. I converted them. The average is 8 billion US dollars. They do pay a really good dividend yield at 7%. The average is 6.4%. To summarize, I have them trading at a 24% discount. Their ratios look decent, but their financials look pretty good. And become a member of the channel, and I could do a more in-depth valuation for you, or we can do a private Zoom session where I show you how to analyze financial statements and answer any questions. See the link in the very top of the description. Thanks for watching.